Welcome back to Yahoo Finance Live. For the first time since October 2018, we saw West Texas Intermediate cross the $70 a barrel price level here as we're continuing to track a change in demand, a spike in demand for oil when it comes to the reopening here. But how is supply catching up to that? And what's OPEC Plus and OPEC got planned around some of the swing factors here as Iran looks to change their output? For more on where prices could go, I want to bring on Bob Iaccino, Path Trading Partners co-founder and Phoenix Financial Research chief strategist, joining us right now. And Bob, good to be chatting with you, man. I mean, when we look at it, how do you break it down? Because obviously we've heard a lot about a super cycle potentially in oil, but when you gauge supply and demand right now, where do we go from here?
Hey, Zach, thanks for having me. One of the things I really like about crude oil specifically is that it is a pure supply and demand market. And if you look at the characteristics of the market itself, it simply trades in a channel sideways until there's a disruption to either supply or demand. Right now, you're seeing that play out with this move up to 70. We're getting a disruption of the old range based on increased demand as most of the globe, at least in the developed nations, start to come out of the pandemic. And that's where most of the demand for crude oil is. So it is definitely a bit of a demand shock. And OPEC, I think, recognizing that they are now the marginal producer as a group, they're now the ones that really control the price. And they haven't had this kind of control for, let's say, the last 6 or 7 years that they do right now. Despite their idea that they're going to pump another 2 million barrels in, demand is below pre-pandemic levels and growing it faster than a 2 million barrel clip that OPEC Plus has promised. So when you look at it from that perspective, crude's doing what it always does. It's responding to a change in the supply-demand dynamics. It's just a grinding change rather than what normally is a bit of a shock, as we've seen when prices have fallen before.
Bob, when you look at the price move specifically, I mean, to what extent do you think this can hold? If we're talking about the demand and the ramp up that we've seen in oil demand because the economies have opened up and we were always expecting a significant spike, how much more upside is there on the demand side and where does that take the price?
Well, I think there's at least close to 10% from where we're at. My initial target was $70.11. We just exited a long position on Friday. Our target 70.11, we got out at 60.95, which is, or I'm sorry, 60.75, which is something we normally do, get out ahead of a target simply because we're not geniuses. We don't have a crystal ball to know the exact price. So we get out beforehand. But having said that, another $7 is not a very difficult thing to achieve. Again, considering when you look at, for example, U.S. rig counts, crude oil since about November 2nd has gone up over 100%, right around 106%. But U.S. rigs has only risen by about 62% from about 221 up to the 359 rigs we saw on Friday. That has quite a bit to do with the lowered CapEx, the lowered risk appetite by the shale producers, and the lack of traditional drilling land on this side of the Atlantic. Now, from that perspective, OPEC has about 6 million barrels of excess capacity, just waiting to do what people used to think the shale patch did, which was just turn the spigots back on. The shale patch has never done that. It's evidenced now by the fact that CapEx has not been put towards new shale rigs for the betterment of the environment in some people's view, but for the detriment of the person who has to fill up their gas tank. So we expect to see gasoline prices rise. I'm expecting at least another $70 on the price. I'm sorry, $7. Should be clear on that. $7 on the price of WTI based off of the fact that OPEC now has control.
Yeah, and I mean, we've seen a lot of job cuts in the shale space here too in the U.S. as well. When we talk about the other swing factor, though, and we look into Iran and what they could have planned there, how do you factor that into it? Because it seems like around their presidential elections could be looking to increase by up to 1 million barrels per day. So how does that factor into the supply and demand mix right now?
Well, so Iran officially is only supposed to be shipping out about 800,000 barrels. Unofficially, according to people I speak to, it's closer to 1.7 million through various tactics that I don't really feel like talking about because I don't have confirmation on those tactics. but the market has about 1.7 to 1.9 million of Iranian crude priced into the market already. So having said that, what is this 1 million barrel in excess production going to be? Is it added to the 0.8 that they're already doing? Is it on top of the 1.7 to 1.9 that my contacts say they're already putting out in the market? They'll just be on Iranian ships now. It seems to me that when you talk to people involved in the physical, there's tankers, for example, the North Sea, where the oil is remaining in tankers because the producers and the distributors of that oil think prices are going higher despite what's going on. They're closer to the situation than I am. So to me, Iran doesn't have enough range to actually affect the supply. The second part of that is OPEC has been saying 2 million barrels, but didn't quite start producing that until late last month, even though they okayed that 2 million barrels quite a bit earlier than that. There's no talk from them to going any higher than this 2 million barrels. So we have to actually look at what comes into production and what actually gets distributed to market. That's a hindsight. It's a hindsight exercise, I understand. But from a perspective, I think a decent amount of that is priced in.
All right, Bob Iaccino, Path Trading Partners co-founder and Phoenix Financial Research chief strategist. Appreciate you joining us here today to give us that take.